as credit risk begins to dominate our thinking, and under those circumstances, I think the forward thinking that an investment manager does has got to sort of, if you like, just encompass those very, very facts. So I think that's what I would say in the current situation.
You underscored there quite a few salient points about the current market conditions and strategies around it. Andy, did you want to add anything about some revelations of official endorsement, even by major players recently, about bond portfolio, the traditional portfolios needing to be broadened to include intrinsically valuable assets, so strategically tangible asset as part of a mix?
Yeah, I think it's important to highlight those in the respect that a lot of what Alasdair is talking about it deals with just this: monetary inflation, asset valuation, the inflation-adjusted value of bonds and equities. When you have a Federal Reserve that has missed their target inflation rate for 55.
Alasdair, perhaps you can lead us, because you've talked to us multiple times before that, how it's always those inside the bubble that are the last to see the weakness.
Yeah, I mean, it is interesting that the first time, certainly during this fiat currency life, which is now 54 years and counting, we actually have major investment managers, or rather, I suppose, investment strategists turning around and saying you ought to actually allocate, 5, 10, 15, 20% of your portfolios to gold. The thing that's interesting is that these big banks, they've got massive amounts of funds under management. And, we're talking about the sort of net worth individual portfolios. The sort of thing I understand people like Goldman's have got about $1.25 trillion under management. Bank of America another trillion. Trillion here, trillion there, and all the rest of it. And they got nothing. They've literally got no gold in there at all. They don't know how they're going to get it. I mean, really. And there's another problem, and that is that how do you invest in gold? Well, your compliance officer won't give you hell if you buy an ETF. But an ETF is actually quite an expensive way to do it. What you should do is buy physical metal and store it properly. And it'll cost you, basis points, no more than that. But the problem there is that gold and silver are not regulated investments. So you've got a lot of explaining to do to your compliance officer. But that's the best thing to do. I'd sort of calculate, if you look at the actual level of exposure at the moment, portfolio exposure to gold around the world, and we're talking about an estimated 300 trillion of portfolios total around the world, their exposure is about 0.5%. If you're going to increase it by only 1%, at current prices, that's 25,000 tons. Where are you going to come from? It's just not there. So I think we're in a situation which we've already beginning to see a squeeze in the market. And this is something Andy is probably a lot closer to than me. But I mean, when I saw all that stuff going out of the Bank of England back in April, the trucks backing up and being told, come back at the end of the month, I started thinking, that's basically leased gold, which before then was just remaining in the vault. Okay, it was a book transfer. So the Bank of Finland would own, say, they would lease, say, 50 tons, and it would be leased to XYZ. It was a book transfer because it would remain in the vaults. Now it's disappearing. Now, if I was a central bank, and I don't think I'm stretching my imagination too far, I would think, hold on, I don't think I want to get involved in this leasing game anymore. I think I'm going to stop leasing because it's now getting more important that we actually have possession of our gold, or at least have it stored without any encumbrances, such as out on loan to someone else, leased to someone else or whatever. So I think that's drying up the whole of the mechanism, if you like, in London. So what I'm saying is that, it's all very well turning around and saying, put 20% of your portfolio in gold. It's not there. And worse than that, the liquidity actually is drying up. Liquidity that's keeping the paper market going, because this leased gold, it gets hypothecated, rehypothecated, rehypothecated. It just goes round and round and round. And it's like spinning plates. You used to have those chaps on the stage with spinning plates on the end of, and you'd go around and get dozens of these things spinning, and see them starting to fall, to get round and sort of get them going. That basically is the gold leasing game. And a lot of this gold is actually gone. It's disappeared. I mean, the leasing game has been going for so long. Analysts back in the last century were looking at it and saying, where's it gone? And they were assuming that after a lot of diligent research, I should add, that up to a third to a half of all central bank gold by 2002 was out on lease. And the way Frank Venerosa put it was probably adorning the necks of women. I actually think China bought it, but who cares who bought it? It's not there. I mean, that's the key thing. So we actually do have this additional problem. I mean, the idea that you're going to have time to, sort of cogitate and wait to see developments and all the rest of it. I mean, you could end up missing the boat hugely on the gold game. And of course, the thing about silver is that it's always been the poor man's monetary metal, as it were. And, if they think they've missed the gold boat, they'll go and buy silver. So, and there's not a lot of liquidity there. I mean, I'm seeing that in China, stocks have dropped to well under 1,000 tons in the SHFE. This squeeze is evident again. And I see that this morning, there's a small backwardation between spot in London and COMEX. So that's returned after one day. I think it's 1 day of normalizing. So the situation, I think, when it comes to, the availability of metal.
You're paying BlackRock and JP Morgan a 60 basis point management fee to, in essence, use your metal to drive the price down. There's an 81 million share short position in SLV right now. And what the hell is that? It's just, as Ed Steer says, it's grotesque. And it is. This drives the price down. It allows them to pull metal off elsewhere. But, you're paying them a 60 basis point management fee. You can store in one of our Brinks facilities for a fraction of that. Real stuff, which you can never take possession of SLV or GLD. It is expensive. But through all of this, and even this month where we've seen a big fallback of 10%, 58,639 contracts taken off. Multiply that times 100, you got 586,000 ounces of gold. No, 5,863,900 ounces of gold taken off the exchange, and multiply that times 4,000. So you're talking an awful lot of money worth of gold coming off just this month, but it's been that way every month since November. So what's the takeaway? Well, the takeaway is this. Starting in 2017 or 17, the central bank started buying and repatriating their gold. And then it proceeded to be the family offices, the hedge funds, the sovereign wealth funds. Now it's the commercial banks are telling us this. And at the same time, but that excluded the New York traders all this time until November of this year. And now every month you're seeing deliveries like this of millions of ounces of gold and silver every single month, billions of dollars worth every single month. And again, call it reverse psychology, use it contrarianism, if that's a word. Why isn't anyone talking about this on the mainstream? Why do you not hear about the record deliveries? Who's taking billions upon billions upon billions? I mean, keep on going, billions upon billions every single month. Who's doing it? Who's bleeding dry the LBMA? Why is there no talk of this? It is because the lack of journalistic integrity or effort on their behalf to tell anyone what's truly happening, including the people who are trying to decide which way to invest, is ridiculous. And it's just like this pullback that we've seen, right? The mainstream media is all over it. And a lot of the things they said are valid. A lot of them are. It was overbought. It had gone up for 9 straight weeks. It had blown through moving averages. It was in need of a correction. They capitalize on all of that, and then they'll put a cap on it and say maybe it's topped and it's over, just like in 2011 and 1980 before that. But what they fail to mention, which invalidates all of it, is that, the snowball that was pushed down the hill to start this going happened in the access market when New York was closed, when there were no markets open before Asia opened, when no trader, Alasdair will tell you, that trader would be fired and shot, not in that order. Any trader that would dump billions upon billions upon billions upon billions of gold and silver at the most illiquid time of the evening, when New York is not open, no traders there to catch that, all you're doing is triggering sell stops that drive the price way down. You are guaranteeing yourself, the worst settlement. And then, of course, who did I mention? Bank of America and Morgan Stanley? Well, Michael Lynch says they came right in and scooped up physical, shows the numbers, and silver went right up. So this is all a game that is being done for maximizing the effect, the fear. And there is not one rational trader on the planet that would do that, would dump it in the access market. They would dump it over hours or days, slowly bleeding it into the system, not telling these traders how much they want to sell, slowly so that the demand would be commensurate with the supply. But they failed to tell you that. They should have said all of these things are true, but they dumped it. They dumped it when there was no market open. So everything they say is invalidated. And all the sell stops that triggered, freaking everyone out, getting all what's going on with gold, what's going on with silver. They never called when gold was going up for 9 straight weeks in a row. And I think the powers that be understood we were entering a period of time where the public was waking up. That's a bad thing when you have a wicked short position. It was damage control. It was short covering. It was fugazi. And you'll see it right back up, I promise you, before the music stops. If this had been done the right way, slowly bled out over days and weeks in New York trading, I'd be less confident. But any idiot, stupid idiot that would dump it like that when there's no traders, well, that invalidates everything that the media said, no matter how rational and logical and valid those statements may be otherwise. That's just my 2 cents.
Well, I actually want to just pick up on an earlier point you were making, Andy. The largest mine in the world is COMEX, because this year so far it's delivered around about 1,200 tons. That's three times China's total gold mining effort, annual effort.
There you go. And who is it? And why don't we hear who it is?
Well, that's for us to guess, isn't it?
So I want to key in on this if we can, gentlemen, and that is that the guidance to ordinary moms and pops has been absolute silence and nothing to see here.
Because there is absolutely no doubt it won't be available at anything like these prices once these things happen. And silver, incidentally. Well, I know it's not a monetary metal, but, if you look at a gold-silver ratio of, 83, 84, I mean, this is plainly ridiculous. It should be 30 or lower. So the 2 monetary metals, I think you take a position in those, and then you've got to play the end of the bubble. And that basically means lightening up on rising prices from here, on tech stocks in particular. Bitcoin, incidentally, correlates beautifully with the Magnificent Seven. So if you've got that as well, I would get out of that. And when it comes to bonds, well, you don't want to be invested in duration. I know that insurance companies and pension funds look at matching, if you like, duration with their liabilities, of course. But as much as possible, you want to go short on duration. I think that's desperately important. And then what will happen, I think, at the end is that your position in gold will actually rescue all the other positions. And that's where you've got to get to. You don't have to have a huge amount of gold to get that. You don't need 20%. But get in there because, as I said earlier, if you look at a 1% increase in gold in global portfolios, that equates to a demand at current prices of 25,000 tons, and it is not there. It's quite simple. So, if you leave this one, you're going to miss the boat.
Thank you, Alasdair. Andy, you've been waiting patiently.
Yeah, I mean, look, I'll try to sum it up best I can. I would say you can't trust a regulator that's also the world's largest debtor. Just because the government backs their industry, the bond market, doesn't mean that bonds are safe. And I would argue the U.S. government won't default. They'll just inflate or suppress yields. But either way, you hold bonds, you lose. And the institutions, they'll bleed real value.
To do yield curve control. That was the time of yield curve control. And you could also persuade investing institutions to act in a certain way. There was all this sort of, if you like, off-the-record briefing of institutions. So, but that cannot happen now. It just does not happen. You cannot have yield curve control. You cannot control the yields on the long end of the bond market. They're no longer controllable. And the fact that we're not tied to a gold standard, which is provides a severe limitation on inflation, if you like, the way prices behave. That doesn't happen either. So, this is an inherently different situation from the past, where we've had higher rates of debt to GDP and got away with it, but not under a pure fiat currency. That's the point I'm trying to make. And I think that is why we're coming to the end of a fiat currency era with everything that implies.
Andy, anything to add from you on that?
From precious metal standpoint, and I can speak to the larger economy after, but you can't keep suppressing a market when the world is pushing back against you. The only way to do so is to push it in the direction that it is going. And as I've said on your show for 5 years now, that the biggest money in the world is wise to suppressing. When you see 8 Western banks holding the largest concentrated short position on 1,000 commodities traded on the COMEX, and that being in silver for years in a row, it's not too hard to see it if you look, that it is certainly a collusion of the West for reasons. And you could argue gold for Gibson's paradox, the inverse relationship between real interest rates and the price of gold. And I would argue silver for the military-industrial complex, the need to make high-tech weapons, the need for massive amounts of silver to do so. And we've talked about that ad nauseum. I don't need to go into that, but the world is wise to us. And this is why you see coordination between countries that are sophisticated and motivated and wealthy now and understand what we're doing and using it against us by standing for delivery. In fact, probably shorting it themselves to do so. That's why China, the largest producer of gold and second largest producer of silver in the world, are actually taking the time to fly to Latin America to buy gold and silver directly from the miners, like Sean Kunkun, Dolly Varden, who told me this, and paying double what the West will, and sending it back for refining when they're already producing more than anyone in the world. Why would they do that if it means nothing? They see the big picture. That will end. And in terms of the way that the sequence goes on the bigger picture, we're seeing inflation spiking, I think. I mean, they're giving up to it. It's at 3%. It's much higher, which we said it's 11, really, if you ask John Williams. And they're going to pour more gasoline on the fire right now, even though they're 50% away from their target. To Alasdair's point, this would lead to bond losses. To Alasdair's point, again, this would lead to central banks panicking, doing yield curve control, suppressing interest rates, which leads to currency declines. And if the currency is declining already in a period of time where no one trusts the institutions and the markets really anymore, because we have weaponized the treasury against countries like Iran and Russia, yet we've been in Iraq for 22 years under false pretenses, destroyed their country, toppled their regime, and we're still there occupying their country. How is that fair? Now, I'm not making any judgment on Iraq or on the Ukraine or Russia war.
If you use the cut we mapped, opening with purchasing power risk, moving through the allocation shock from big banks, the paper vias physical tension, the gold-silver ratio case, and closing on why suppression narratives keep colliding with real-world demand. The U.S. macro backdrop only sharpens the argument. In 2025, the fiscal picture stopped being an abstract debate and started showing up as line items that portfolio managers can't ignore. By mid-August, Treasury reported the national debt at roughly $37 trillion, years ahead of pre-pandemic timelines, and the climb has accelerated in trillion-dollar bursts. That's not a meaninglessly large number on a scoreboard. It flows straight into term premia, refinancing needs, and the political economy of rate policy. In the edit, when your guests talk about the debt trap, you can now anchor that to the fact pattern of the past several months, which shows both a rapid pace of gross issuance and a public conversation that's shifted from whether debt matters to how quickly interest costs are crowding out other priorities. Those interest costs, more than any single headline about the deficit, are what transform the theoretical into the tangible for allocators. Treasury's own data show fiscal year-to-date net interest outlays crossing the trillion-dollar line in 2025, with average rates on marketable debt now far above the near-zero era. Whether you believe the Fed cuts more or less than the futures curve implies, the math of rollover risk is already embedded in the bill-to-bond mix the government must fund. That is the bridge from regulator-debtor skepticism in your cold open to the practical concern that long-duration sovereign bonds no longer hedge equity drawdowns the way textbooks promised. In a cycle where inflation is sticky and term premiums are not inert, the standard 60-40's negative correlation can go missing right when you need it most, something investors felt in 2022 and intermittently again in 2024 to 2025 as stocks and bonds both wobbled. The clip will land harder if you tie that explicitly to the government's cash flow reality. Interest is no longer background noise. It's a first-order input to markets. That's why the mid-show turn toward precious metals doesn't read like a gold bug cul-de-sac anymore. It reads like mainstream risk management. In the past few quarters, large house strategists have said the quiet part out loud. Morgan Stanley's CIO publicly backed a 60-20-20 framework, equities, bonds, gold, an explicit admission that treasuries may no longer be the most reliable shock absorber when inflation surprises and deficits swell. Even if a given CIO's mix evolves, the direction of travel is clear. Carve meaningful room for bullion. For an audience of U.S. allocators who grew up on the 60-40 gospel, that is a sea change, and it makes your panel's "this isn't a trade, it's insurance" message feel less contrarian and more institutional. Keep this moment intact in your cut, and when it plays, you can layer the latest quote cards or on-screen lower thirds to show how a 20% gold sleeve is no longer fringe theory but active guidance. The physical side strengthens the case further. Central banks didn't just buy a little gold in 2022 and move on. They bought more than 1,000 tons again in 2024, marking a third consecutive year above the 1,000-ton threshold. For U.S. viewers who are still used to thinking of gold as an ETF ticker, that stat reframes the "who's on the other side" question. If official sector demand is systematically converting reserves from paper claims into bullion, policymakers explicitly diversifying their macro hedges, then U.S. private portfolios that keep a zero-to-token allocation are swimming against a multi-year flow. Your guest's early adopter language stops sounding alarmist when you juxtapose it with those central bank purchase totals because it implies a longer, steadier bid beneath the futures tape. Silver, the segment you want to emphasize in this edit, is where macro hedge and industrial reality intersect. The Silver Institute entered 2025 projecting a fifth straight market deficit, with industrial demand expected to hit new records as solar manufacturing, electrified transport, power electronics, and even AI-adjacent data center buildouts chew through more high-conductivity material. Unlike gold, silver's supply response is complicated by its status as a byproduct of lead zinc and copper mining. You don't just dial up primary silver output when price spikes. That structural constraint is exactly why your panel's remarks about liquidity tightness and backwardation will resonate with a U.S. audience that has watched semiconductors, grid components, and renewable inputs become national security issues. If policy still aims at domestic clean energy build-out and onshoring of advanced manufacturing, silver's industrial pull has a domestic policy tailwind too. In your cut, let the silver section breathe. The macro, debt, deficits, fiscal dominance explains why investors seek hard assets, but silver's use case explains why the metal can lead, rather than merely follow gold when demand heats up. Framing the paper versus physical contrast carefully will also help U.S. viewers who have only ever owned metals through tickers. You don't need to litigate every detail of ETF structure or warehouse stocks to make the point. Instead, pair your guest's remarks about rehypothecation and deliverable supply with two observable developments: the official sector buying streak and the broadening acceptance of a larger gold sleeve from mainstream Wall Street CIOs. Those two facts, taken together, justify a portfolio construction conversation about how much exposure should be unencumbered and how much can be tactical via futures or ETFs. It's less about dunking on paper and more about matching instrument to purpose. If the purpose is ballast against policy error and currency debasement, a core physical allocation, stored transparently and outside the banking system, plays a different role than a trading line item. The edit's fourth segment, where the gold-silver ratio comes up, is your on-ramp to talk about relative value rather than just absolutes. U.S. investors intuitively understand mean reversion. They've seen it across factors, styles, and commodities. When the ratio sits in the 80s after multi-year structural deficits in silver and record industrial offtake, it's not unreasonable to frame upside in silver as both a macro hedge and a spread trade versus gold's leadership. You don't need to promise a snapback to 30-1, avoid spurious precision, but you can credibly say that if central bank buying remains sticky, deficits persist, and the U.S. fiscal position continues to worsen, the conditions favor silver gradually clawing back some ground. In portfolio terms, that can justify nudging a metal sleeve toward a higher silver weight than the last decade's habit would suggest, particularly for investors willing to tolerate higher volatility in exchange for torque to reflationary policy and manufacturing capex. Recent price action will help bring skeptics to the table. Through March and again into the autumn, gold punched into fresh nominal highs before backing off, the kind of stairstep that accompanies geopolitical stress and rate cut chatter. The important part for your narrative is not the exact tick. It's that fresh highs occurred in spite of a strong dollar at times and in spite of equity enthusiasm when AI froth resurfaced. That behavior reinforces the idea that gold in 2025 isn't just the fear trade, it's also the policy hedge for investors who worry that the easiest way to manage towering debt service in an election-reshaped Washington is via real rates kept below nominal growth. Tie this to your opening reel about purchasing power risk and the loss of trust in the 60s-40s free hedge. It will feel cohesive rather than conspiratorial. If you want to make the moment visual, show a simple price inset at the exact time code when your guest says the largest mine is COMEX. Viewers will map the price arc to the structural story without you belaboring it. What U.S. allocators still need is a concrete how, not only a why, the panel already sketches it: lighten momentum equities into strength, shorten bond duration, and replace part of the bond hedge with metals. The new element is that there is now cover for doing this in committee. When a bulge bracket CIO publishes a 60-20-20, investment committees can debate implementation rather than ideology. That means drafting an IPS addendum that defines the role of metals, insurance, not yield. The form, some split of segregated vaulted bars and liquid vehicles, and the rebalance rules, e.g., trim into rips back to long-term channel highs, add-on funding stress dislocations when liquidity dries up and spreads widen. For silver specifically, you can note in the voiceover that the industrial bid makes drawdowns more jagged, so position sizing should reflect higher volatility and less accommodating market depth. That's an argument for dollar-cost averaging and for keeping a part of the sleeve in ultra-liquid instruments for tactical pivots. It's also worth reminding U.S. viewers that the metal story isn't purely a bearish macro bet. In a soft landing scenario with modest disinflation and rate cuts, gold and silver can still do constructive work. Gold is the cleaner reserve diversifier as long as central banks keep buying. Silver is the levered beneficiary if an investment upcycle in power grids, EVs, and high-density electronics persists, regardless of whether GDP is printing 1.3% or 2.1%. That dual-path logic is important for fiduciaries who must defend positions to boards that fear betting against America. You're not. You're just acknowledging that America's funding model and industrial policy both tend to pull metals higher for different reasons. If growth softens and the Fed cuts faster, real yields compress and bullion benefits. If growth muddles through and capex continues, silver's industrial pull remains relentless. That's the thoughtful middle ground your panel implicitly offers. Finally, loop back to the human side your host stressed. Ordinary savers who rely on institutions to manage pension assets, endowments, and insurance reserves. The lesson of the past 2 years is that diversification by label, stocks good here, bonds good there, is not enough when the underlying driver is fiscal sustainability and the credibility of money. Diversification by risk, which includes assets without an issuer, has re-entered the mainstream. The news flow is now your friend in making that case. $1 trillion here in added debt, $1 trillion there in interest. CIOS, rewriting the most basic recipe in asset allocation, official buyers steadily absorbing bullion, and a silver market that, by reputable industry methodology, sits in another sizable deficit with record industrial offtake. Those are not fringe data points. They're the core facts behind your guest's most quotable lines. If your 20-minute cut foregrounds those facts, cleanly, without sensationalism, you'll have a segment that doesn't just preach to the choir, but gives prudent U.S. investors a realistic playbook for the world as it is, rather than the one they grew up in.